Hey there, this is Dave Mantell with Stabler Wealth Management. Thank you for joining our webinar today. The topic of today's webinar is how to take tax-efficient retirement income. I sort of think of it as a retirement income machine. And we've received a lot of inquiries, especially with all the changes, the layoffs, the early retirements coming from Boeing, in terms of, okay, now I'm retired, what do I do? How do I keep my lifestyle in retirement? What's that look like? And so based on that, this is a timely presentation and one of the more important ones for retirees especially, in terms of how you actually take good, tax-efficient, sustainable income in retirement. So I will, let me share my screen here and we will get the presentation going. Okay, perfect. One thing I did want to mention is that while this is a very retirement-y topic, I'd say this applies for anyone in pre-retirement as well that's preparing for retirement. We're going to hit on a lot of themes here, whereas you think about those 2-3 years ahead of retirement, strategies, things to be thinking about, how to position your investments, your tax planning, to lead to a stronger retirement income result and outcome. And so I absolutely, anyone in that retirement planning phase, so we generally think of that as a 3 years ahead of a potential retirement, don't go anywhere. This is for you as well. Okay, well with that, so what we're going to be covering today, we're going to break it into 3 different topics or groupings. The first is best practices for taking income in retirement. What do I do? How do I do it? How do I determine how much to take? Where do I take it from? So that'll be the first section. From there, we're going to go into, okay, what are proactive tax saving strategies, both in how do I take tax efficient income in retirement, but also other things I should be doing to allow me to continue to take tax efficient income for the rest of my lifetime. These early retirement years, the gap years, you may have heard me refer to those, are critical in that regard. So we're going to go over some key strategies, both in taking income, but proactively for setting yourself up in the future. And then the last section, very critical, is how do you align your retirement income strategy with your investment strategy? The two need to be talking to each other. As you're taking out income, we need to think about how to do that from your portfolio. How does your portfolio support that? How does it recalibrate? And so that'll be the final section. All right. And so before we launch off, a little bit of background on who I am, who you're talking to here. So I'm a managing partner with Stabler Wealth Management. We're a team of certified financial professional planners, so CFPs, and we specialize in working with Boeing employees and retirees. And we've been doing that for decades, and still today we have a real focus and expertise in that regard. And our whole goal is to provide personalized advice and care for those that are working at Boeing, preparing for retirement, transitioning to it, retired, to help you get better outcomes, live your best life, enjoy your family, and not have financial stress. And so this is what we do every day. And so a lot of these topics that we cover, we've seen this in practice play out for many, many, many clients. And so you are not the guinea pig is the good news. We have more information on our website, planyourboeingretirement.com, where we post videos, webinars like this, articles. So check it out. Okay, so section 1, when we think about taking retirement income, we commonly refer to it as a retirement paycheck. And really, it's the same way as when you're working. You have expenses that you incur every month. You need income every month to offset those expenses. And so having a regular paycheck, a system for it, is really number one key in this regard. And so when we think of that concept of a retirement paycheck, we want to be sending you monthly withdrawals from your investments to emulate the same way you got your paycheck when you're working. And so as you can see in this visual, every month, start of the month typically, you may want to receive $6,000, $7,000, $8,000 from your investments, and that will be used to cover your groceries, pay off your credit card, cover ongoing travel, things like that, just kind of normal things that happen throughout the month. From there, we like to supplement with one-off withdrawals, so lump chunks as needed. And so an example is, um, hey, every once in a while, you're going to buy a new car. You're going to do the real big vacation, the bucket list one. You're going to help fund a grandchild's, education account. And so those one-offs, you don't want to be taking out extra money every month that's just sitting in your bank, not earning anything. And so the best way to go about it is, again, to match your normal monthly expenses to your monthly withdrawal, your retirement paycheck. And then as you have one-off needs, you'll take those out of your investment portfolio as the time comes. And that way that money's earning, it's being saved, it's working for you. It's not just sitting in your checking account not doing anything, but you have it at your fingertips when you need it. Because every year we're going to have these one-off purchases come up, right? It's going to be a different flavor every time. And so that's sort of the structure. Not that different from when you're working. I think, one optimizer. So usually when you're working, you get your normal paychecks. People tend to kind of amass money in savings, take the money out of savings, when you need it. This is actually much more efficient where instead of money sitting in your checking account accruing, anything beyond your target cash balance. We all want a comfortable amount in the bank at all times. For some people, that's 20,000. Some people, that's 40,000. But anything beyond that, we could have earning good interest for you, and then you grab it when you need it. And so this is sort of that, starting foundation of how to take income in retirement. And so from there, step one when taking out income in retirement is how much do you need? And so that all starts with saying, hey, what's a normal month look like? What's my credit card most months that I need to pay off? If you have a mortgage payment, you got to factor that in. And so it's just in a normal month, what do I need coming in the door? And so that's a spending plan. And so 2 ways to go about it. The real best way, if we're going to do it right, and I recommend this exercise for everyone at some point, is, we have a 2-page spending plan, front and back, has the main food groups of spending, gym membership, groceries, eating out. And it's really good and empowering to take a couple hours on a Sunday and fill that out. And this is basically does 2 things. One, you have an idea of where your money's going, because it is always eye-opening in the world of Amazon and all the online purchases this day. It's so quick and easy to spend money, right? And so most of the time when we have clients do this exercise, they'll be like, oh my gosh, am I really spending that here or there? And so as you're moving into retirement, that allows you to kind of get retirement ready and fit, make sure your money's going where you need it to, right? Especially as you're taking money out now, you're not in the savings mode. And so this is a wonderful exercise to do. For someone that's saying, hey, I'm wrapping up with Boeing here, this month, I'm done now. I need to get retirement income going right away. I will do this exercise. A good starting place is when you are working, how much was hitting your bank each month? And trying to at least emulate that. And again, it's not what you were earning every month because you had money going into 401k, you're paying money towards taxes, you're doing all, different types of things. It's what's the cash hitting your bank. And so that's a starting point to emulate that, because generally people spend more in those early years of retirement than when you were working. And again, you got more time on your hands, right? You don't got to be clocking into the office. You're able to do that trip that you always wanted to do. So it makes sense. So you're going to maybe save money on dry cleaning and a couple things, but that's going to be quickly offset with more time for leisure activity. And so at a minimum, we want to at least emulate having you hit the same amount hitting the bank every month. Does that make sense? Yep. Okay, good. From there, so the good news is for most retirees, basically all retirees, you do have some income streams in retirement. It is not going to be to the same level of what your wages were when you were working in your highest paying years, but we want to think about pension money coming in, deferred comp, Social Security when that flips on. You may have a rental property that provides real estate income. And so we want to add up all those pieces, and then any shortfall comes from your investment portfolio. And so to the example, let's say you need $10,000 a month hitting the bank. And you say, okay, I got pension money. Maybe you did the deferred comp program. You got some money coming in there, or you have another income source. So you might be, okay, I got 3,000 coming in every month. I need 7,000 remainder. So that's what would be coming out of your portfolio. On this note, don't be alarmed if you're saying, well, I'm not Social Security age yet. I got to take it all out of my portfolio. Gosh, this is going to be brutal. It's not just a static, hey, you're retired. This is how much you can take out. We need to look at the body of work over time. And so what I mean by that is you look at this visual. In the early years, this retiree didn't have Social Security coming in. When their spouse turned 62, they started their Social Security. So that's why there's a little bit of dark blue starting a few years out. And then in this case, they deferred or waited until they maxed theirs at 70. So then the dark blue went up a ton. And so those yellow bars early on, where you're taking withdrawals from the portfolio, are larger, but a lot of that's replaced by Social Security. And then in your 70s, you have to take RMDs, required minimum distributions, right? And so it's an evolution over time when you think about retirement withdrawals. And so it's very common where somebody retires and they may be taking out a 6% plus withdrawal. You go on the internet and it's like, oh no, 6% is no good. But once Social Security flips on, that person may be in the threes, right? And so again, you got to look at the entire body of work. And the good news is we have amazing tools now that do all this. So for every client, every person we meet with, we will run a retirement sketch, run a scenario, see how it looks over time. How do we take withdrawals? How do we support that? And so there's a lot of tools to see how this evolves. But again, it's looking at the total body of work over time. Okay. And so basically you figured out what's been hitting your bank as a starting point. Ideally you do the spending plan, but at least what's been hitting my bank, so that's what I need. Okay, what income do I have coming from other sources, if any, early in retirement? And then that's the difference you should be taking out from your portfolio. Okay, good. Yeah, everyone's following? Good. Okay, so now that we decided, okay, how do I figure out how much to take out? What's that look like? The next component is, okay, how do I do this in a tax efficient way? How do I save on taxes? How do I make sure I'm not in a tax pickle down the road? I like the tax headlock, right? That's kind of a good, imagery. And so with that, we call it the retirement income gap years. But essentially, when you retire, let's say you take a lump sum or you don't have a pension, right? See, there's no pension. When you retire, it may feel a little weird, but no pension, you haven't started Social Security yet. Your taxable income is basically zero to start the year. Blank canvas, right? Because you have no wage income in that situation. And so while that could be a little scary or intimidating, that's also exciting where, we have a lot of room in the lowest tax brackets to use up and leverage. And so we call these the gap years because it's the years from when you retire, so no wage income, but you haven't started Social Security yet, you're not required minimum distribution age. And so those are gaps where you don't have these like set structured income coming in, but it's also gives you a lot of flexibility for tax planning. And so when we think about this, withdrawal location is key, right? And so what that means is that when you take money out of your IRA, your 401k, every dollar is taxed as ordinary income. So you take out $7,000 a month, that's showing up on your tax return. And you got to come up with how to pay the taxes, right? So do a withholding or something. When you take money out of a bank account, you've already paid tax on it. So if you take 20 grand out of your bank account and spend it, that's not a taxable activity. Same concept with a non-retirement account, like a brokerage account. When you take money out of that, you only pay tax on the gains when you sell something. And so commonly, we'll send clients retirement income out of the brokerage non-retirement account if you have one. And that doesn't generate any taxable income in many cases. And so we could be at the end of the year, someone might have withdrawn $100,000 from a non-retirement account and still not use up any of their tax income. And so this is a great opportunity, same way, with a Roth, no tax income. But essentially, you have no wages, you don't have Social Security yet, you're not on RMDs. We're taking your withdrawals from the most tax efficient, the non-retirement account. And then that gives us a lot of room for taking capital gains at a 0% tax rate, doing Roth conversions at 0, 10, 12% tax rate. And so really common in these gap years, we're able to get more money into a client's Roth account. Many times you may be at an effective average tax rate of under 10%. It's pretty amazing. But these are just really good years to set you up for more flexibility in the future. Okay. And so, as noted on that last bullet, utilizing the non-retirement feeder account where you take your income from. And then under the hood, we're refilling that from other accounts. We're doing Roth conversions. We're taking stock gains to do so at a really tax efficient way. Okay. Okay, good. With that in mind, there's also the benefit of keeping an eye on the future. And so a Roth conversion, I know I mentioned that on the last slide, that is essentially moving money from an IRA or 401k, so a pre-tax, tax-deferred account, to a Roth retirement account. And when you move the money to the Roth, you're paying tax when you do so at whatever tax rate you're at. Once the money's in the Roth, there's no taxes. It's tax-free. And so this is a really, powerful tool to use in those early gap years to set yourself up for the future. And so, for example, in the gap years, we might be doing Roth conversions, all type of stuff, and you may only be at a 10% effective tax rate even after all that when the dust settles. Or we may do more to be at a higher tax rate, use up the 22% bracket, still favorable. And so an example of this is, so commonly all the time we'll work with a new client. They may have $2 million in their 401k. They've done a great job saving. They're pumping money away, but that's where all their savings is, right? And so that's what they have, $2 million in a 401k or IRA. And so when you take money out of that retirement account, every dollar's taxed as ordinary income. When you're 73, you have to take out a certain percentage, an RMD, required minimum distribution. And so between Social Security and RMDs, someone may be showing really high income in retirement and be forced to take out more than they're spending even. So that could drive you into a higher tax rate. On top of that, we may see taxes go up, right? We're in really favorable tax rates right now. In addition, if you're married and you or your spouse pass, the survivor is now in a single tax bracket. And so the tax rates tend to be higher at the same income level. Another example is that, the way the rules work now, when your heirs, your children inherit your retirement accounts, they only have 10 years to take it out. So it could show a lot of taxable income on top of their own income. And so there's all these things where you could be in this tax headlock that I've alluded to before and be stuck in a really, really higher tax bracket without flexibility. On top of that, hey, I need a new car. I need to fix my roof. I want to do this renovation. To access those funds, every dollar's taxed as ordinary income because it's coming out of your 401k or IRA. And so, that could drive it. I see it all the time, well into the 30% tax rates in certain years. And so back to my example, using those gap years to do strategic Roth conversions, we have countless clients where, now rather than just having all $2 million in a pre-tax account that's really unflexible, over the years by chipping away at the Roth conversions in those gap years, we see it all the time where they have $500,000 now in a Roth account. And what that allows is avoiding going into a higher tax bracket, helps down the road with taxes. There's no RMDs on Roths, and those are tax-free. Your kids can inherit that portion as a Roth. Gives us flexibility on how to invest accounts. So again, keeping an eye on the future, things you're doing today, especially in the early retirement years, provides a ton of flexibility down the road. Okay. That was a mouthful. So I hope that sinks in a bit. We've done other videos on that topic too, so you can check it out on our website. And I'm going to go to the end. I encourage everyone to reach out to us, set up a time with me. This is what we love to do. This is what we do every day. And we could go over that. But again, you could tell I'm passionate about it because it's a big deal. That's one of the biggest levers you can pull. Okay. The other thing, so at Boeing, a lot of folks, get early retirement income early retirement health insurance to bridge to Medicare age. But in many cases, depending on when you were last hired at Boeing, folks at other employers, tend to not have that early retirement health insurance coverage. For a lot of people, getting to age 65 Medicare can be a really difficult thing without getting hammered with higher insurance premiums. Because the way it works is when you have to self-insure, use a private, so instead of being on an employer insurance plan, you have to set up a private plan as an individual. When you do that, your insurance premiums are largely based on your tax return income. And so same thing, by setting up more flexibility early in retirement, that gives you a lot of flexibility to keep your insurance premiums down. Once you're on Medicare age 65, your Medicare premiums are also influenced by your tax return income. So they call it IRMA. It's a surcharge penalty. It acts like another tax. And so as you can see on this chart on the bottom, if your income is over $200,000 as a couple, and by the way, that's really easy to hit between RMDs, required minimum distributions, later in retirement, Social Security, pension, dividend, interest income. But it's an extra $2,000 a year per couple for Medicare insurance. If you're in a year where you sell a property or need to take big retirement draws and your income is much higher, it could be as much as $12,000 additional. And so that is a big hit. That's a huge another tax and something that we see come up very commonly in retirement. So again, these are all things that set you up with that eye on the future to save money on taxes, have more flexibility down the road. Okay. Again, I packed a lot into this slide, so I hope everyone's still following. But the good news is it's something we could talk about more to your specific picture going forward. Okay, good. Okay, so we went over how much retirement income to take. How do we do it in a tax efficient way? Kind of a third leg is we need a strategic withdrawal plan where your retirement income is aligning and talking to your investment portfolio. Okay. And so when we think about creating a withdrawal strategy, you see the treasure chest, we call it the war chest, but basically it's this concept of the stock market is very volatile. In any given year, it could be down. Sometimes it's down a lot. Over more years, it becomes more crystal clear, but it can at times not feel good, right? That is only a problem when you have to react to it. So 2022, stock market's down 25%. If all your money's in stocks and you're newly retired, you're having to sell your stocks at a low, right? And that is a real loss when you sell something at a low. And so the whole idea is we want our growth investments to be longer term, to stay ahead of inflation, build wealth over time, even in retirement. And so we like to take the withdrawals from a less volatile investments. We call it the war chest, that are still making money, but they're more income oriented. So it's a more steady Eddie approach. And what this allows us to do is that when the stock market's low or tanking, we don't have to sell your stocks, right? We could buy more stock even in retirement. So you're buying low. When the stock market's at all-time highs, right around where we are now, you're able to, sell the stocks and take some gains to refill the war chest. And so it creates a really nice yin and yang, kind of effect that works together in that regard. Okay, so this is something people get wrong a lot. So something really important to think about. And so when we do that, you can think of it as 3 buckets. This is a good visual that we like to use. Bucket 1, preservation, cash equivalents, bank money, CDs, treasury bills, money market, where you're earning interest, not as much as other places, but it's not moving around, right? That's money that you need in the next 6 months, 1 year, 2 years. It's going to be there when you need it. So that's a real short-term bucket. That more moderate bucket, years 2 to 7, in some cases 10. Again, we don't want to take huge risk, but we don't need this money tomorrow, right? We're going to be accessing it in a couple years, and so those are still income-oriented investments, but we want to get a bit higher income, higher yield than the cash bucket, the preservation bucket, right? And so those are kind of those middle years. Money you're not going to touch for a decade plus, right? While it's not fun going through volatility, that is a long time to let it recover. And so we want that to grow, be powerful, stay ahead of inflation. And so what we're doing is that your withdrawals are coming out of a preservation bucket. And so we need to refill that periodically from the income bucket. The income bucket, as we're moving money to a preservation bucket, we need to refill with a growth bucket. And we want to do that at ample times when there's taking gains. And so having a good rebalancing reinvestment strategy that does this in a really intentional way is a huge recipe for success there. Okay. Good. And so those are kind of the three legs as you're moving into retirement and taking retirement income to really be thinking about. As we mention every webinar, complete a trial run of your retirement plan. Even if you just retired, you want to map out what this looks like, right? You need to be guided in this. You don't want to just be shooting from the hip. This stuff's too important and you can't get it wrong. The margin for error is much less in retirement and the stakes are much higher because you're taking money out. You're not working, you're not earning, you're not adding. And so you just can't really make big mistakes on this. The good news is once you retire, you're at a point where you're financially independent, you're self-sufficient. But it's really important to lay out an income plan so you can stay that way, right? We don't want any dusting off resumes in a couple of years here. We do a free second opinion on your retirement plan, free complimentary session. Everybody on here should do it. I'm telling you, it doesn't cost anything. There's no obligation to work with us. This is just what we do, and it's a benefit to you. And for many of you, it may totally make sense to work with us, right, and have a partner on this. For many of you, I think you'll just get some good information out of this, right, to help you make sure you're going in the right direction. And so take us up on this. This stuff's so important. Go to our website, planyourboeingretirement.com. Type it in now. You can do that, and there's a big button at the top right, Let's Talk. And so when you click on that, that takes it to a booking calendar where we'll actually set up an initial booking with me. And in that session, we'll talk through what your goals, what you're trying to work out, what that looks like, information that's helpful. And then we could set up a full kind of deep dive hour session from there. The good news is most people do this, that attend the webinars. This is what like a big chunk of my week is doing, and I love it. So take us up on this. This is what we do every day, and it's just too important to get wrong. Okay. We're going to keep these coming. Even if you're retired from Boeing, ping us so we have your new email. We have a lot of topics for retirees, not just Boeing, people from Boeing looking to retire. Pass our info to your colleagues. This is how we meet new people. Go to our website. We're posting new information all the time. Last month, we did a really neat piece on evaluating the pension. Is it safe with all the issues Boeing's going through? Good news is the answer was yes. Not to ruin the whole conclusion there, but we keep it coming, and we get a bunch of good ideas from folks that attend these. So really love it when you send us, hey, I've been curious about this, or this is a topic I've wanted to do, because I guarantee you're not alone. So anyways, looking forward to meeting you, a lot of you, through that session. Reach out with questions. Best of luck if you're newly retired. It's going to be amazing. If you're thinking about retirement, fantastic. I'm happy to work through that with you. And we'll keep them coming, so we'll talk to you all soon. So appreciate you signing in and joining. Take care. Have a great rest of your day.